In today's episode, we will cover whether you should prioritize income over capital growth with your investments. Let's get it. Welcome to the First Principle channel, where we talk about ideas that will help you overcome the obstacles that will potentially be blockers for you to live the best life you can. In this episode, we will explain what capital growth is, what it means to invest for income, and considerations that you should have in deciding whether you want to focus your investments on things that will generate income for you, or whether you want to grow your investment portfolio, the size of your investment portfolio. Make sure you stay tuned to the end of this episode, as we will have some bonus information at the end of the video on what you can invest in to achieve some very good income potential. Of course, this channel is for infotainment purposes only. As such, nothing you hear in this episode or other episodes should be construed as financial advice. These are just ideas that you should consider in the way you build your wealth based on where you are in your journey, or what investment resources are available to you and what your appetite is. Alright, let's get it. Okay, let's start by defining a few terms here. When we talk about capital, what do we mean? So let's go to Google. Capital meaning. As you can see here on Google, we will go to the second meaning, and it says capital is wealth in the form of money or other assets owned by a person or organization, or available for the purpose of starting a company or investing. So we'll take the part about investing. So in simple terms, capital, if we go to a new slide and we type, capital is the money you have available that you want to use to invest. So that's what capital is. Now, when we think of investing, most people are looking for one or both of these objectives. The first objective is income generation, and the second one is capital growth. Now, what do these two things mean? Basically, income generation means that you put in money into an investment, and this money you have put in generates some fixed or variable amount for you over a defined period. For example, you can invest 1,000 GBP and expect to get 100 GBP per month from your investment. Whereas capital growth has the objective of increasing the value of your investment. So if we look at your investment of 1000 GBP, you could be looking for something that allows the size of your investment to grow over time. This would mean that you could have your investment become GBP 1100 in 12 months time. The truth of the matter is there are few investments that guarantee that the value of your investment will grow over time. As you will see in most investment notes, you will be told that the value of investment can go up or go down, and that's the reality today in the market. Whereas it is possible for you to make an investment that could potentially give you a fixed amount, maybe every month, or every quarter, or every year. So, for example, if we go into the internet now, and let's say we go to Yahoo Finance and we enter a company like Microsoft. And if we go to the charts for Microsoft, you will see that Microsoft, where it says DDD, that's the indication that Microsoft pays dividend over time. So Microsoft pays about 51 cents per share in dividends on a monthly basis. So Microsoft can be considered to be an income generating asset. However, if you also look over time, the value of Microsoft is growing over time. So Microsoft could also be considered as a growth investment. And so Microsoft is an example of an investment that generates income and also has the potential to grow. However, like I mentioned earlier on, if, for example, you had invested in Microsoft on the 7th of February 2020, you would probably have gotten in to Microsoft at the price point of about $185 per share. Now, fast forward to the 18th of March, the value of your investment in Microsoft would be $135. So that means you would have lost about $50 worth of your investment. There is no growth. If you had exited your investment in Microsoft on 18th of March, then you would have been paid a dividend of 51 cents per share, but you would have also recognized the loss of about $50, which is not what anyone wants. However, if you had stayed with your Microsoft investment up until the 17th of November 2021, the value of your investment would potentially have doubled from $185 to about $342 per share. And in the process, you would have received monthly dividends that you could potentially have invested in your Microsoft portfolio. Before we continue, please can I ask that you do the internet a favor and smash that like button and share this content if you think there's someone in your network that needs to hear what you've heard so far. And if you haven't done so already, please hit the subscribe button so that you're the first to see new videos posted on this channel as soon as they're live. And also hit the notification bell so that you don't miss the content as soon as they're uploaded. Thank you so much for your support. Really appreciate And of course, if you've got a comment about your experience with investing, please leave them in the comment section down below, and we'll be sure to look at it and respond as much as possible. Thank you so much. This is really, really good for us. Now, back to the video and talking about investing for growth versus investing for income. All right, so let's take another example. Popular company, Google. Let's call up the Google shares. So assuming you invested in Google the 14th of February 2020, your investment in Google, you would probably have paid $1,520 GOOG. The date of investment is 14th of February 2020, and your investment amount was $1,520. Now, if you look at the chart of Google, if you had panicked and because the price of Google had gone down to $1,072 on the 20th of March 2020, so let's put that 1,072. If you had sold, instead of your capital appreciating, you would have recognized a loss of $448, which would be a loss of about 29% of your investment. That's not what anyone wants from their investment. So most times when you're investing, you want to invest for the long term. So assuming you didn't panic, you believed in the value of Google and the company Google as a whole, and you held on to your stocks till the present day with all the fluctuations. Today, your Google shares, the one share of Google that you have, would be worth about $2,587, which is the 13th of April 2022. So current date is 13/04/2022, and your shares would be 2586.59. Now, let's look at what has happened over that period. Your capital growth would be that, take away that, about $1,000 increase in your capital growth, and your capital growth in percentage terms would be what it is now divided by that. So you would have gained 70% over 798 days. And so if we analyze that, this would be that times 365 days in a year divided by the number of days. So that's an average of 32% in capital growth per year from February 2020 to April 2022. A 32% growth on any investment is not bad at all. But if you look at Google shares as a whole, you will realize that you would not have received any income. And that is the definition of capital growth. Now, of course, like I mentioned, if you had exited Google in March of 2020, you would have incurred a loss. In fact, if you had exited Google anytime before July 2020, you probably would not have realized any capital growth. If you had exited Google in September 2020, you would also not have realized any capital growth. The only time you could begin to realize capital growth would have been from November 2020 onwards. So that's the point about capital growth. You have to wait it out. And the value of your investment could go up or it could go down. In this case with Google, in December 2020, the value of your investment would have been $21. Today, the value of your investment in Wish would be $2. So that's a huge drop in the value of your investment in the company Wish. This is the reason why some people shy away from looking at capital growth, because the truth is, it's difficult to see into the future and know what is going to bring the most return. It has gone up. If you had invested in a company like Wish, you see, for example, with Wish, if we look at an investment in something called Credit Suisse X-Link Gold Covered Call. So this is a type of investment that is managed by the bank Credit Suisse. We could then begin to see where the value is. So if you look here, Credit Suisse pays dividend every month. So let's put that here. The ticker symbol is GLDI. And let's use the same date, 14th of February 2020. So on the 14th of February 2020, if you had bought into this investment, you would probably have paid 9.29. So we'll put that down, 9.29, which means that a $1,520 investment would have given you that, divide that, 163.62 shares. Now, if you look from February 2020, if we go back, February 2020, yeah. From there on, you would have started receiving dividend. So let's see if we can put them together. So what's the total of that? The total income you would have received per share over that period would have been, drum rolls, 2.42. Now remember, you invested $1,520. That gave you 163 units. So your total dividend payout that you would have received over that period would have been $395. And this is assuming you didn't reinvest any of that money. So your return on invested capital over that period would have been 26%. And if you annualize that, that would have been a 12% return on investment over that period, which is also not a bad return on investment. The value of your investment today would be just slightly less than what you paid for it in 2020, because today, the 13th of April 2022, GLDI is in the market for about $8.64. So the value of your investment is down from back then by 65 cents, which represents a drop of less than 7%. However, if you look at the chart for Credit Suisse X-Link Gold Covered Call, you could have also said to yourself that, you know what, I invested 9.29 in in April, and I would like to have exited my investment on the 18th of August 2020. And if you had done so, you would have been able to get out of that investment for $10.39. So $10.39, which means that your gain, aside from the dividend that you would have been paid, would have been $1.1 per share. And when you take that and multiply that by the number of shares that you had, you would have gained $179, which compared to your investment of $1,520 would have been an 11% investment less than a year after, which is also not bad. So you would have gained 11%, you would have also collected the income, and you could have gone on to use that investment to go into some other asset class that you see as providing you an opportunity. So as you can see from the comparison of these two investments, as with most investments, the value of your capital can go up and down. Whereas with the Google investment, there was no income potential, only the promise of the value of that portfolio going up. And then the question you need to ask yourself is, at what point do you exit the portfolio to be able to realize some profit? And how do you determine how you exit that portfolio, or how much of that portfolio do you want to exit? Because let's be honest with ourselves, no investment is worth it until we can convert it to cash at some point. However, when you think about the investment in the Credit Suisse ETN, the GLDI, for as long as you remained in that investment, there was a high chance that you were getting the dividend. And so the beauty of investing for income is when you have those fluctuations that go up or down, because you have income coming in at constant pace, you're kind of emotionally stable. You're not in a hurry to get rid of the investment. And the other thing that is interesting about this Credit Suisse is it really hasn't fluctuated down beyond a certain amount. And so you kind of know what is the baseline for where you want this investment to be. And so it's easy to put in a lot of money in an investment like the GLDI with the hope that you will get unending streams of income, even though not guaranteed as well, over time. Now, of course, you can invest in asset classes that can pay you both income but also have the potential for growth. And we saw that with the example of Microsoft that we looked at over time earlier in this video. Another example, which I'm going to show now, is an asset with the symbol KYN, which is Kane Anderson MLP Investment Company. Now, if you look at the summary of this investment, based on what we see here, the forward yield of the investment is about 8.72%, which is above the inflation in most countries, or a lot of countries today. Can't talk about some. But in addition to the dividend that it gives, there's also, apart from the huge drop that we saw before 2020, it has been in a steady upward trend and still paying out that dividend. So that's the point. The question each one of us needs to ask ourselves is, what is our reason for investing? Are we looking to get money, a big lump sum in the future, or are we looking for steady income that will come to our pockets over time. The reality is, if you invest in something that will give you steady income over time, you could actually get to a point where that income is paying for your expenses and allows you to be able to lead a comfortable life. And there are people who have retired from a proper 9 to 5 because they've invested in assets that pay them regularly over time. So let's take the example of GLDI here. Assuming you needed to generate £5,000 or $5,000 in income for yourself every month, how much would you need to invest in GLDI? How much would you need to have invested in GLDI in 2020 to give you $5,000 per month? If we think about the fact that GLDI pays an annualized income of 12%, so this will then mean that your investment in GLDI would be less than $500,000. So if you had invested about $497,000 in GLDI in 2020, you could actually sit down at home and not have to do any work for the rest of your life if you're able to earn $5,000 per month to pay all your bills. That, in my view, is not a bad way to live life compared to no guaranteed future for investing in an entity like Google. And that's not to say investing in an entity like Google is a bad idea. So I hope this makes sense. The bottom line here is you have a choice. You can invest for growth or you can invest for income. In a future episode, if you come back, we will look at options, stock options, as an opportunity to increase the value of the income you're able to generate. So please drop by next time. And like I said, if you haven't subscribed to the channel already, please do so. Smash that notification bell and share this content with anyone that you think will find it useful. Thank you and goodbye.